When you look at the stock market, you see an obvious overvaluation. Some acknowledge this fact but are simply riding the wave. Others can't see the indicators because their heads are buried in the sand. If there's one thing that's constant, it's that people quickly forget. No matter what the situation is, they always seem to get caught up in the euphoria, and then it's too late. You came here for the truth, so let me unveil that for you. Today we're going to look at what happened last time around. Let's begin. Technology now makes up a quarter of the stock market, its biggest weighting since the dot-com bubble. Can you believe it? That tech makes up 25.1% of the S&P 500. That's its highest weighting since November of 2000. We are seeing the euphoria taking place, and the market is going parabolic when you look at the tech stocks specifically. Tech is up 8.4% in 2018 and has skyrocketed 35.7% over the last year, leaving all other sectors in the dust. If you look back into the pages of history, you see the financial crisis. And while there were some sectors declining, housing and those interconnected with it, people were looking for a place to park their money. And so tech was that final place before all sectors started falling. So it was tech that sort of picked up the pieces and had that last little bit of investment potential before it all fell down. And we could be entering that same situation today. But you can see regardless that we are now at the levels seen in the dot-com bubble. It's approaching that slowly but surely. We are now witnessing the parabolic nature that was going into 1998, 99, and perhaps around that stage today. We are watching it sort of beginning of what will be a parabolic rise as the central banks continue to infiltrate. Only other time above 25% was from November 99 to November 2000. It peaked at 34.81%. And that is when you know it's gone too far. A lot of people can ignore these details, and that's fine. But ultimately, you have to pay the price. Look at Apple as an example. I just took this one particular example. Look at where it has gone since the financial crisis. There have been ups and downs along the way, there is no doubt. However, we can see that the price continues to rise. Why has the price of Apple risen? Does it have anything to do with their sales? Does it have anything to do with their performance, their corporate profits, or anything else? What about this? Berkshire Hathaway. You can see here, Berkshire owns 165 million, give or take, shares of Apple. When you buy 10 shares of Apple, if you buy 100 shares of Apple, it is completely insignificant to the amount of shares that a company like Berkshire Hathaway owns. We need to realize it isn't individual investors that make a difference at all. Even if we pool a whole bunch of them together, it does not make a difference when you have massive conglomerates buying up companies like Apple and other, tech stocks. Then you have the fact that the Fed, the central banks around the world, the Bank of Japan, the Swiss National Bank, the Bank of Norway, they're all printing up money and buying shares. Let's face the music. We know what's happening here. We know why they've been rising. S&P tech sector and the S&P market cap, you can see what has happened here. Rising up yet again, we haven't seen these levels in a long time, and nobody seems to be worried about it. People will continue to increase their purchases of stocks like Apple. It's going to happen. They are going to not only deleverage from the situation, but they're going to pull money out of other sectors and put it into tech. Happens every single time. Every single time. Just look at the cycles, just look at history, and you will see for yourself. Okay, now those fully diversified individuals, when they own some of the stocks, some of the bonds, and they believe that they're diversified. I've heard this one many times before of people in the financial industry. And the return, monthly return, unfortunately hasn't been this bad in years. Look at what has happened here. It's not just particular stocks that we need to be worried about, because there is contagion. You can't just say, okay, well, that particular company, it's not doing well, the sales are not good, therefore I'm going to take my money out and I'm going to put it in this company instead. That may save you temporarily, but ultimately the dominoes will fall, and you need to understand that it happens every time, so why would this time be any different? Dow closes 380 points lower, snaps the longest monthly win streak since 1959. I was actually very surprised about this because we had seen so many month-over-month gains that I thought it could have gone on forever. Forever and ever, unlimited gains. But apparently, not the case. The major averages erase gains from earlier in the session to close sharply lower. The Dow and the S&P 500 snapped a 10-month winning streak, their longest since 1959. The Nasdaq posted a monthly loss for the first time in 8 months. So we are seeing extreme levels of asset prices right now, particularly equities, that yes, they've come down from their peak, but I mean, look at where they've come from. You need to understand how far. And remember, we still have one very important event that needs to take place at some point in the future. And I'm really, really looking forward to it. And that is QE4. QE4 will be the event we've all been waiting for. And I am just itching for it to happen. The US economy expanded at a slightly slower, not true, pace than previously thought in the fourth quarter. GDP grew by an annualized 2.5% in the final 3 months of last year. It's interesting the way that they project all of this nonsense. We were told by the GDP Now forecast, Fed Atlanta produces those numbers, suggesting it would be nearly 5%, somewhere around this range. 5% wasn't anywhere close to that. Wasn't anywhere close to that. And I'm sick and tired of all the lies. They project these things, and all the time they have to revise them downward. Every day they're just revising it downward, slowly and slowly. The dollar versus gold. Now, doesn't matter if you like gold or not. The reason I mention this is simply because we always price things in US dollars. If we're always pricing things in US dollars, we get one very linear picture. But that's not accurate. Everything priced in USD is going to look a certain way throughout many decades. But what happens when we price it in, for example, gold? What happens when we price it in wheat? What happens if we price it in other commodities like oil, or the dollar versus the Dow Jones, or the dollar versus any asset? It doesn't matter. Or the Dow Jones versus gold, and the Dow Jones versus just name it, okay? Pricing one thing against another instead of the US dollar. And that's what we need to do. And it really starts to paint an interesting picture, to say the least. The dollar has lost about 98% of its purchasing power since the year 1900. Gold has increased 53.9 times in the value of that time. and therefore 1.8 times 53.9, 97% of the purchasing power retained by gold. Anything will hold value except for the currency that we measure it in. And that's why the average person doesn't do well, and the more wealthy, the more affluent people who are able to afford assets, they do well, especially generation after generation. They keep those assets, hand them on to the next generation, and then they're able to multiply that. But others who are less fortunate, they don't have anything to pass down, and unfortunately, that's a tough break. But what we need to do is hold on to assets. Doesn't matter what you hold on to, even if it is paper assets, it will probably do better than the currency, simply because the currency is always intentionally being devalued. If you found this video informative, I know you'll find my books, The Money GPS, even more informative. You can actually flip through these books at Amazon. If you go to the link below, it'll bring you over there. There's a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.